Hey folks, welcome back to Honey Money SG, and today let's talk about how to save your first $100,000 by the age of 30. Now, saving your first $100,000 is one of the most incredible feat, especially in the initial stage of life. And as Charlie Munger said, right, your first $100,000 will be the most difficult task, but you must do whatever it takes to get there. So in this video, I want to help you guys map out a plan so that you can take some baby steps in order for you to achieve your first $100,000 by the age of 30, and maybe give you some advice along the way. A quick background on myself, right? I actually achieved $100,000 by the age of 25. Now that's not because I have a really high income, but that's because from young I really have a frugal lifestyle. I have very minimal expenses and I save a lot when I was earning income as well. I also started providing tuition services at the age of 21, so that helped me build some of my income sources, especially at that age when I was still studying in university. And even so, I also paid half of my tuition fees while the other half is sponsored by my family. So I have been there and done that, so I'm very sure whatever that I say today can help you a little bit in achieving that first $100,000. I think today I'll be very relaxed mode, right? Let me give a very reasonable assumption of this scenario that you may have. Okay, I'm going to use a fresh graduate. So he's about 25 years old, male. Why male is because male actually served 2 more years of national service, right? So at the age of 25, he will graduate and start his full-time employment on his first job. Now for ladies, you have to deduct 2 years because they don't have to serve national service. And let's make the bold assumption that this guy has zero savings before he graduated, right? Because he spent all his money, whatever money that his parents gave him, he just squandered all over it. And let's assume that this guy who has just graduated is fully focused on his full-time career, so he does not have time for any side hustles, side income, or alternative income sources. Now the one last assumption is that this guy has also zero debt, which is quite important because some of us will have to pay our own tuition fees. But for this assumption, I'll assume that this guy, his parents has paid for his university tuition fee and his loans, so he don't have to worry about any debt. Okay, so moving on, let's go to the cash flow breakdown, right? So let's just assume that this guy, in his first job, he actually achieved to get a $3,600 of monthly salary. Now $3,600 is kind of the median, right? Because we have really high income earners, especially in the tech and the fintech space, earning more than $5,000. And then we also have the other side, the lower ends, where fresh graduates are earning around 3K plus. So I believe like 3,600 is quite a reasonable number to achieve and maybe a realistic target to set for our fresh grad salary. And let's just assume that in this job, there is no AWS, that means no 13 months, no bonus, and no salary increment over 5 years. Okay, so this is a really conservative estimate already. Let's just assume that this guy is really quite useless in his job and the boss don't want to promote him every year, don't even have pay increment, no bonus at all, right? 3,600 monthly for 5 years of his life. So now let's break down his income, and as you know, we have to pay 20% of our pay to CPF. That's for our retirement planning, and that's quite important. So CPF 20% will be $720, and if we subtract that amount from $3,600, we will be left with $2,880, and this is the take-home pay. And let's just assume that this guy is really filial to his parents and they gave like 10% of his monthly salary, which is $360. So we deduct another $360 from 2,880. For personal expenses wise, this guy is just living with his family, and let's just assume that he spends an average of $1,000 per month on his personal expenses. Now that's excluding family allowance of $360 that we talked about earlier. And let's say he watched the Honey Money SG channel and realized that he need to start investing. So he will set aside $1,000 every month and put into an index ETF, right? So let's just budget $1,000 for investment every month. And now his net savings is actually $520 in cash, where he will put in the bank that earns 0% interest. For the investment wise, since he's putting into an index fund, I would say give an average of 7% return if you're investing in the S&P 500. Of course, the past performance is not an indicator of future performance, but let's just take a conservative 7% year-on-year return. I think that's quite alright. Okay, so this is our game plan, right? Our cash flow breakdown. We invest $1,000 every month. We save $520 every month. The rest will be his family allowance, his CPF, and his personal expenses. years, which I believe is quite a reasonable assumption, right? So now let's see how much would this guy have accumulated by the time he reaches 30 years old. Let's start off with the cash savings first, right? $520. Very simple because it saves the same amount of $520 every month at 0% interest. So let's just take $520 multiplied by 12 and multiplied by 5. Then we'll come up to this number of around $31,000 of cash savings by the time he is 30 years old. So 31k is already secured. We are going to find the next 69k for this guy, which is going to come from your investments. So let's say $1,000 if we actually invest it every month, dollar cost average into the S&P 500 index, which you can sign up using my referral link at Tiger or Mumu Brokers to get your one free Apple stock into tickers like VOO or SPLG that tracks the S&P 500 index at a really low expense ratio. So that's really a win-win for everyone. Just buy the index fund, 7% return, I think not too shabby and really quite safe. And the risk is quite manageable as well, especially when you do dollar cost averaging. So I'm going to take out my financial calculator. This time I'll key in a payment of $1,000 every month and my annual rate of return is around 7%. So I'll put all my numbers into this calculator, which will calculate for me how much would the investment grow to by the time this guy reached 30 years old. So I already provide this link over here. You all can go and play with the calculator and put in your own numbers to see how will it turn out for an investment like that. And so after 5 years of compounded growth, our guy here will actually achieve a total accumulated investment of $71,200, right? So if we add that up to the 31.2k earlier, then we will come up to a total amount of $102,000, which is $2,000 more than your original $100,000 by the age of 30. So you can see this simple exercise actually quite reasonable, right? My assumptions used are really quite conservative. This poor guy don't even have any salary increment or bonus, which is really quite sad. If your company didn't even give you increment or bonus, then I think you should go and find a better job first instead of focusing on how to do this exercise. But the point that I want to make here is that achieving $100,000 by the age of 30 is really not difficult if you follow to this roadmap. And what is actually the difficult thing is to actually keep your spending level consistent. Now, because some people, when they actually earn a higher level of income, they will have this lifestyle inflation, right? They have more money, they will upgrade whatever they buy, they will increase their spending on discretionary items and all that luxury stuff like buying a car, buying a bigger house, and exposing themselves to more liabilities. So as long as you can keep your spending consistent and avoid lifestyle inflation, then I think this roadmap will be very reasonable for everyone to achieve. Of course, one more thing is that past performance is not an indicator of future performance. So 7% for S&P 500 index is really quite conservative and reasonable, but sometimes the S&P 500, especially in year 2018, did not grow at all. In fact, it fell quite a bit. But of course, if you stay long term in the market, it is more or less guaranteed that the stock market will continue to grow every year because companies continue to outdo themselves and their competitors and achieve more growth for investors. Anyway, none of this is constituted as financial advice. I'm just sharing a very simple math calculation for all of you who are aspiring to reach the first $100,000, that it is really doable. Even for some guy like this guy who is really so uninspiring, right? I think that one more thing is you should work on increasing your income at your early stage of career, because that is actually the biggest boost that you can have on your cash flow and your revenue sources. If you feel that your job is not paying you at the correct pay grade, then you're always welcome to job hop, right? I think it's not that frown, especially for young people. Or if you feel that your job is okay and you have some spare time, then why not consider doing a side hustle, right? There are a lot of services that you could do, especially with the rise of internet. You can do a lot of things online. But one last thing I really want to highlight is that you must be able to find a partner who have the same mindset as you, because no point that you are here living frugally and managing your expenses, and then you have a partner frivolously spending his or her money and does not align with your financial goals. Because if you guys do decide to get married in the future, his or her influences will have an impact on your whole family net worth as well. So having a really thoughtful and aligned mindset spouse is really the most important thing than earning more income and having the low expenses. Because if your mindset don't align, then not only you will not have a good financial position, you also not have a good marriage, which is more detrimental to your mental health in the long run. So I really urge all of you, find a partner who have a correct mindset that is aligned to you. So once you have achieved your first $100,000 by the age of 30, the next step may be how to achieve your full retirement sum by the age of 30 in CPF. And that's where you have to watch this video, because I'll show you how have I done it right. With that, thank you for watching. My name is Christopher. This is Honey Money SG, steering young adults to financial independence.